We're going to take a look at how small beginnings can lead to big, lasting success. So buckle up. Now, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. Also, drop your location and the local time in the comments below. I love hearing where you're watching from. Now, dim the lights, maybe turn on a fan for that soft background hum, and let's ease into tonight's journey together. When you think of wealth, what comes to mind? Some might picture extravagant mansions or a fleet of luxury cars, while others think about financial freedom, being able to enjoy life without the constant worry of where the next paycheck is coming from. But here's the thing, none of that starts with huge leaps. It starts with the smallest of steps. It's easy to get caught up in the idea that financial success requires massive, bold moves. But as I've learned over the years, the true secret lies in starting small and thinking big. You don't need a mountain of cash to make your first investment. All you need is the willingness to start. And that's the first habit you need to embrace. I've always believed in the power of starting with what you have. When I first started investing, I didn't have millions, heck, I didn't even have hundreds of thousands. I began with small amounts, taking steady, thoughtful actions over time. I built a foundation, brick by brick, until I could stand on solid ground. That's where a lot of people miss the mark. They focus too much on making big moves right out of the gate, thinking that one giant step will change everything. They want to jump straight into big deals, fancy stocks, or hot trends, but that's not how lasting wealth is built. It's about consistency, patience, and small, smart decisions that snowball over time. Let me give you a simple analogy. Imagine you're building a house. You start with the foundation, right? You don't jump into installing the roof or picking out furniture on day one. You lay the bricks, one by one, and slowly but surely, you have a structure. The same goes for your financial life. The foundation is built on small, consistent habits, things like budgeting, saving a bit each month, and making smart, informed investments. But here's the kicker. Each small step doesn't just add to your wealth. It compounds. And that, my friends, is the key to transforming those small habits into something much bigger. Remember, it's not about how much you start with. It's about what you do with it over time. And this compounding effect works in ways you might not even realize. That initial investment of $50, if you keep at it, keep investing that same amount consistently, over time, you'll be amazed at what it grows into. It's like planting a tree. Each small action is like watering the roots. At first, it doesn't seem like much, but eventually, that tree starts to bear fruit. And by the time you realize it, that tree is strong, tall, and producing more fruit than you ever imagined. But don't just take my word for it. Let's talk about a little something called the snowball effect. The snowball effect is one of those concepts that sounds cliché, but in reality, it's one of the most powerful forces in the financial world. And it's all about starting small. Picture yourself standing at the top of a hill with a little snowball in hand. At first, that snowball is tiny. But as you roll it down the hill, it gathers more snow, growing bigger and bigger with each rotation. The same principle applies to your investments. The earlier you start, the more time you have to let your money gather momentum. The snowball effect doesn't just apply to money, it applies to your skills, your knowledge, and even your ability to make good financial decisions. But it's not just about throwing some cash into the market and hoping for the best. It's about being strategic, being disciplined, and staying focused on the long term. That's where the magic happens. If you can train yourself to focus on the small wins, the small habits, the small actions, you'll be in a much better place to enjoy the rewards down the road. The most successful investors aren't those who take huge risks every day. They're the ones who have mastered the art of starting small and sticking to their plan. They understand that slow and steady wins the race. They don't get distracted by every shiny new stock or trendy investment. Instead, they keep their eye on the prize, the long-term goal. So, how do you start? Well, here's my advice. Take it one step at a time. Start with a budget, even if it's just for a small amount each month. Then, look for simple, low-risk investments that you can handle. Don't worry if it's not glamorous. Don't worry if it doesn't seem like much at first. The point is that you're starting, and that's what matters. Before you know it, those small steps will add up, and you'll find yourself looking at your finances with a sense of pride. You've built a strong foundation, and it's starting to bear fruit. You've embraced the power of starting small, and now you're reaping the rewards. It might not seem like much at first, but trust me, in time, those small steps will lead you to places you never thought possible. Let's get into something that's really going to turn the light on for you. I'm talking about compounding. Now, when most people hear that word, their eyes glaze over. But trust me, this is the thing that will really make your money work for you, not the other way around. And before you assume you've heard it all before, I want to let you in on something a little deeper. Compounding isn't just some abstract financial term. It's a law of nature. Imagine you're standing on the beach, watching the tide come in. Slowly, steadily, the waves come in, one after another. Each wave is like your investment. Small, incremental, but with the power to reshape the entire shore over time. That's compounding. Here's the thing. Compounding works in a way that's almost magical. But the trick is that you have to let it work. You can't be in a rush. If you're thinking of a quick buck, forget it. Compounding rewards those who are patient. Let's take a look at an example. Imagine you start with just $100 over the next year. You earn a modest 10% return. You might think, well, that's just $10, not much to write home about. But here's the kicker, because your return is calculated on the total amount you have. The next year, you're earning 10% on $110, not just $100. And the year after that, you're earning 10% on $121. Do you see where this is going? The longer you let your money compound, the greater the snowball effect. It grows faster and faster as time goes on. The power of compounding is in its ability to accelerate growth, but only if you give it time. And I'm talking about years, decades. If you're really playing the long game, here's where it gets interesting. The earlier you start, the better off you are. Take Warren Buffett, for example. He's often said that his biggest advantage was starting early. Even when the amounts were small, he didn't have a fortune handed to him in his 20s. In fact, most of the wealth Buffett is known for today came after he hit his 60s. But the reason he got there was because he understood the magic of compounding. Imagine if you could start at 20 and let your money grow for 40 years. That's the power of time. Compounding isn't just about how much you invest. It's about how long you let it grow. The best time to plant a tree was 20 years ago, but the second best time is now. So, if you haven't started, don't wait another day. But let's not just take it from me. There's a guy you've probably heard of, Albert Einstein. I've read that he called compounding the eighth wonder of the world. Now, I don't know if that's true, but when Einstein starts talking about something like that, you'd better pay attention. Compounding, though, isn't just about financial investments. It's about the small actions you take every day, whether it's saving a little more, learning about new opportunities, or simply getting in the habit of paying attention to where your money is going. It all compounds. If you make one good decision today, it will lead to many good decisions tomorrow. That's the magic. I know this sounds like a lot of theory, but trust me, it works in practice. I've seen it firsthand. There's no shortcut. There's no magic pill. But if you can stick to the simple habits that drive compounding, you'll be amazed at where you'll be in 5, 10, or 20 years. But here's the catch. Compounding only works if you don't take the money out too soon. If you're in the habit of cashing in early, you're not giving compounding a chance to work. You've got to let it grow. Let those waves keep coming. And before you know it, your little pile of sand is a mountain. But just to be clear, it's not all about being passive either. Compounding rewards action just as much as it rewards patience. You've got to keep feeding it. Add to your investments regularly. Don't just sit there waiting for it to happen on its own. And that's where a lot of people get it wrong. They think that compounding means doing nothing, sitting back, and watching the money roll in. It doesn't work that way. If you're not adding to your investments, you're not giving your money the fuel it needs to grow. It's like planting a seed and then never watering it. You've got to stay engaged. Now, let's talk about a little-known fact. When you're young, you're probably not thinking about retirement. You've got other things on your mind. But this is where compounding can really change the game for you. The earlier you start investing, the less you have to invest to get the same result. If you start at 25 and invest $200 a month, you'll end up with a nice chunk of change by the time you retire. But if you wait until you're 35, you'll have to invest more to reach the same goal. Don't wait. Start small. Let the magic of compounding work for you. All right? Let's slow things down a bit and talk about something that's incredibly important but often overlooked. Patience? Patience gets a bad rap in today's fast-paced world. We're all taught that speed is king, get rich quick, make big moves fast, and keep pushing for more. But the truth is, the best decisions, the smartest investments, and the most rewarding financial moves come from one thing: waiting. Yes, you heard me right, waiting. Now, I'm not saying that you should just sit there with your money in your pocket and hope it magically multiplies. Patience, in the investing world, isn't about inaction. It's about understanding that the best results often come over time, not overnight. This is something I've preached for decades, and it's the reason I've had so much success with my investments. Slow and steady wins the race, but only if you give it enough time to actually run. Think about it this way. The stock market is like a roller coaster. It goes up and down, twists and turns, and for most people, it can be a little terrifying. You may feel the urge to jump off the ride when it starts going downhill. But what you don't realize is that if you stick it out, you'll end up at the top again just like you did before. This is the essence of patience in investing, riding the highs and lows with your eyes on the long-term prize. But here's the thing, many people are too quick to panic when they see their investments dip. They sell, they pull out, they miss out on the inevitable recovery. And here's where I need to remind you. You're not looking for short-term wins. You're in this for the long haul. I've seen it over and over: investors who panic at every dip and miss the bigger picture. The key is not to act on impulse, but to have faith that, over time, things will balance out. Let me give you an example. When I bought shares of Coca-Cola back in the 1980s, the stock wasn't exactly soaring, but I saw something that others didn't: the potential for consistent growth over the long term. I didn't sell when the market dipped, and I didn't pull out when the stock wasn't making huge gains immediately. Instead, I sat back and let the company grow, and in time, it paid off handsomely. Now, you might be thinking, well, that's all fine and dandy for you, Buffett. You had the luxury of waiting for years, and you're right. I did, but here's the secret. Everyone has the ability to invest with patience. It's not about having the luxury of time, it's about using time to your advantage. When you invest wisely, and you commit to letting those investments grow, you're setting yourself up for long-term success. There's a bit of psychological magic that happens when you stop focusing on immediate returns and let your investments breathe. When you don't chase every little market fluctuation, you allow yourself to make better, clearer decisions. You stop getting caught up in the noise, and you begin to focus on what truly matters: the big picture. A lot of people think that to be successful in investing, you have to be on top of every little change, every single piece of news that comes out, and every new trend, but that's not true. The key to long-term success is doing your homework, making smart decisions, and then letting things unfold in their own time. It's like planting a garden. You can't rush the flowers to bloom. You have to water them, give them time to grow, and then enjoy the beauty of your patience. Now, I know this isn't always easy. We live in a world that demands instant gratification. But financial success doesn't work that way. If you want to see real growth, you have to give your money time to do its thing. This isn't about quick wins. It's about building a solid foundation for the future. Let me share something with you that I've noticed over the years. The people who succeed in the investing world aren't the ones who constantly chase the next big thing. They're the ones who stick to their plan, wait for the right opportunities, and remain steady, even when the market seems uncertain. It's the same reason I've always said, the stock market is a device for transferring money from the impatient to the patient. In other words, if you want to get rich, you have to be patient enough to let your investments grow over time. It's not about timing the market perfectly. It's about sticking to your strategy and giving it time to pay off. But here's the tricky part. Patience isn't just about waiting passively. It's about waiting actively. That means making sure that while you're waiting for your investments to grow, you're also looking for ways to improve your strategy, adjust when necessary, and stay informed. Patience isn't about sitting on your hands. It's about knowing when to act and when to hold back. And when you do act, you do so with conviction, knowing that the time will eventually come for your patience to be rewarded. So, if you're feeling anxious about your investments, or if you're starting to doubt whether you made the right choices, Take a deep breath and relax. You don't have to make drastic changes every time the market takes a dip. Sometimes, the best move you can make is the simplest one. Sit back, stay the course, and give it time. And here's the thing. When you finally see the results of your patience, when your investments have grown, and your financial life has transformed, you'll look back and realize that the waiting wasn't just a necessary part of the process. It was the best part. Let's shift gears a little bit, shall we? Now that we've established the importance of patience, it's time to talk about something that, honestly, doesn't get enough attention: sticking to what you know. There's a term in the investing world that I've become known for, and it's called staying within your circle of competence. And let me tell you, this one simple rule has saved me more than a few times. It's one of those quiet principles that often goes unnoticed. But when you embrace it, it can make all the difference in the world. At the core of this idea is the simple truth. Don't invest in things you don't understand. It sounds almost too simple, right? But here's the thing. Most people don't stick to this. They chase after hot trends, the latest tech startup, or the next big thing because everyone else is doing it. They throw their money into areas they have no real knowledge of, and then wonder why things go south. I've always said, never invest in a business you can't understand. If you can't explain how a company makes money, you probably shouldn't be putting your money into it. It's all about recognizing where your expertise lies. I'm not saying you have to be an expert in everything, far from it, but you do need to know what you're dealing with. For me, I've always stuck with industries I understand deeply: insurance, banking, consumer goods. I didn't just pick these sectors because they were safe or boring. No, I chose them because I truly understood them. I had enough experience in these areas to be able to see their long-term potential. I didn't jump into something like biotech or cryptocurrency just because they seemed popular at the time. I stuck with what I knew, and that's what kept me grounded. The problem with chasing trends or following the herd is that it's often driven by emotion, not logic. You see it all the time in the market. Everyone gets excited about a stock or a trend, and suddenly, everyone's buying in. But when the excitement fades, those same people are left scrambling, wondering why their investment isn't paying off. The truth is, trends come and go, but understanding a business, its market, and its long-term potential, that never goes out of style. I can't emphasize this enough. You don't have to know everything. In fact, it's better if you don't. The less you know, the less likely you are to make risky, emotional decisions. And, trust me, those emotional decisions will often lead to disaster. But when you stick to your circle of competence, when you invest only in areas you truly understand, you're not gambling. You're playing a strategic game, and that's how wealth is built. There's a famous story I like to tell about my early days, when I was still learning the ropes of investing. I could have gone for big, flashy companies in the tech space, but instead, I decided to invest in a little company that sold textiles. It wasn't glamorous. It wasn't the next big thing, but I knew it, and I understood how it worked. I stuck to my principles and saw steady returns because I had a deep understanding of how the company operated, how it made its money, and what it needed to succeed. It wasn't about picking the sexiest stock. It was about picking the one I understood the most. Here's a fun fact for you. I'm often asked how I know so much about all these different industries. Well, here's the secret. I don't need to know everything, but I do need to know enough. That's the beauty of focusing on your strengths and sticking to what you know. It's about being brutally honest with yourself about your limitations and not trying to do it all. You can't master everything, but you can certainly master a few things, and those few things can make you a fortune. But here's the kicker. This principle doesn't just apply to investing. It applies to your life in general. If you don't understand something, don't try to fake it. Whether it's an investment, a business venture, or a career move, if you don't understand it deeply, step back and learn. It's about being honest with yourself and acknowledging where your knowledge is strong and where it's weak. The same rule applies when it comes to making business decisions. I've seen many people get caught up in trying to be entrepreneurs without truly understanding the industries they're entering. And let me tell you, that's a quick way to lose money. Successful business owners are those who know their product, their market, and their customers inside and out. They don't just guess, they understand. And that's why their businesses thrive. So, what does this mean for you? It means, quite simply, that you should never be afraid to say no when it comes to an investment or opportunity that doesn't fit within your circle of competence. It doesn't matter if it's the hottest new trend, the latest technology, or a guaranteed win. If you don't understand it, don't touch it. Instead, focus on finding things that make sense to you, things you can study, things you can fully comprehend. And, just so we're clear, sticking to what you know doesn't mean that you can't learn and grow. Over time, you'll expand your circle of competence. You'll start to understand new industries, new markets, and new opportunities. But it's a gradual process, and it comes from a deep, patient understanding of the world around you. But for now, start with what you know, and don't let the pressure to chase trends make you forget the basics. Stick to your lane, and everything else will fall into place. All right, so you've been sticking to what you know. You've started small, and you've learned the power of patience. Now let's talk about something that's just as important, but far too many people overlook: diversification. And no, I'm not talking about throwing your money into every single thing under the sun just to cover all your bases. That's not diversification. That's called spreading yourself too thin. True diversification, the kind that works, is about spreading your investments in ways that lower risk and keep things balanced. Imagine you're at a dinner party. You're sitting at a table filled with all sorts of dishes: pasta, salad, steak, vegetables, bread, and desserts. You wouldn't eat only one thing all night long, right? I mean, a whole plate of just dessert doesn't sound like a healthy meal. It's the same with your investments. You want to have a variety of different assets: stocks, bonds, real estate, maybe even some alternative investments, to ensure that if one part of your portfolio takes a hit, others will continue to thrive. Diversification is like building a balanced meal for your financial future. It keeps things healthy and sustainable. I know when people hear diversify, they often think of some overly complex portfolio with dozens of different assets, from international stocks to commodities to cryptocurrencies. But that's not what I'm talking about. Real diversification doesn't mean having 50 different things in your portfolio. It means being strategic. It's about understanding where the risks are and spreading your bets in a way that limits your exposure to any single point of failure. For instance, if all your money is invested in one industry, one company, or one asset class, you're playing a dangerous game. Let's say you've put all your money in tech stocks. Now, I know tech can be a lucrative space, but what happens if there's a sudden market downturn or a major disruption in the tech sector? If your entire portfolio is tied up in that one area, you could be in trouble. That's why it's important to mix things up. Let's take a historical example that I'm quite familiar with: the market crash of 2008. Now, you might remember how devastating that time was for a lot of investors. Banks and financial institutions were failing, and the housing market collapsed. But here's what happened to those of us who were well diversified. Yes, we took a hit, but we didn't lose everything. The reason: our portfolios weren't overly dependent on any one sector. While real estate and financial stocks took a nosedive, other parts of our investments, like consumer goods, utilities, and healthcare, were still stable. And that stability kept us afloat during the storm. Now, this doesn't mean that you should avoid risk altogether. In fact, risk is essential to growing your wealth, but it's about balancing risk with reward, making sure that the losses you might experience in one area won't wipe you out entirely. Think of it like driving a car with a seatbelt on. You're still moving forward, but you've got safety measures in place just in case something goes wrong. Here's a quirky little tidbit for you. Did you know that during the Great Depression, people who had diversified portfolios, even with small amounts in bonds or utilities, actually fared better than those who only held stocks? The stock market was brutal during that time, but those with a broader spread of assets didn't suffer nearly as much. It's funny how history has a way of teaching us the same lesson over and over again, isn't it? But let's get down to practical advice. When it comes to diversification, think about spreading your investments across different sectors, industries, and even geographical locations. You don't have to go overboard. Just make sure you're not putting all your eggs in one basket. It's about balancing risk and growth in a way that makes sense for you. You might choose to invest in a mix of stocks, bonds, and real estate, for example. Or you could add in some international stocks or even alternative investments like gold or commodities. The point is, You want to have a variety of things working for you. And let's be clear, diversification isn't just about mixing up the types of investments you have. It's also about making sure you're diversified within each asset class. For example, if you're investing in stocks, you don't want to just buy a few shares of one company. Instead, look at buying stocks across different industries. Get a little exposure to healthcare, some consumer goods, maybe even some tech stocks. The more variety you have, the more you can reduce the overall risk of your portfolio. But remember, true diversification doesn't mean jumping on every bandwagon or throwing money into things just because they sound interesting. It's about making informed decisions. You want to know what you're investing in, why it's a good fit for your portfolio, and how it will hold up during different market conditions. One of the key principles of good investing is to not get caught up in the excitement of the latest trend. You might see a hot stock and feel the urge to jump in, but that's exactly when you should ask yourself, does this fit into my diversified strategy? If it doesn't, you're probably better off sitting it out. Diversification is all about avoiding overexposure to any one asset. So don't let FOMO, fear of missing out, drive your decisions. In my own experience, some of the best decisions I've ever made were not the ones that promised the highest returns in the shortest amount of time. They were the ones that gave me stability, the ones that kept me balanced, even when the market was volatile. Diversification isn't about hitting home runs every time. It's about making steady progress with a portfolio that can weather any storm. So, take a step back, look at your own investments, and ask yourself, are they truly diversified? If not, now's the time to make some changes. You don't need to go crazy, just focus on spreading things out in a way that makes sense. Diversifying your investments is like adding more ingredients to your recipe. It creates balance, and it keeps everything from falling apart when things get a little shaky. Now, let's dive into something that's crucial to your success as an investor: emotional control. It's easy to hear the word investment and think about numbers, charts, and reports. But let me tell you, the real battle isn't in the numbers, it's in your mind. Emotional control is what separates the successful investors from those who chase fleeting trends and get caught up in the chaos. Let me set the stage for you. Imagine you're watching the stock market. It's been a rough day, and the market's dropping. Maybe your favorite stock is down 10%, or your whole portfolio's taking a hit. What do? If your instinct is to panic, sell everything, and cut your losses. Well, I hate to break it to you, but you're not following the right playbook. In moments like this, emotional control is everything. You see, the market has two big enemies: fear and greed. Fear makes you sell when things are down because you think you're losing everything. Greed, on the other hand, makes you jump in headfirst without considering the risks, simply because you think there's a fast payday waiting on the other side. Both emotions, while natural, can wreak havoc on your financial decisions if you let them take the wheel. This is where emotional control comes in. It's about learning to master your emotions so that you don't make irrational decisions based on temporary feelings. I've always said, the stock market is a device for transferring money from the impatient to the patient. The truth is, the most successful investors are the ones who can stay calm in moments of uncertainty. They don't let fear or greed control them. Instead, they stay steady, follow their plan, and wait for their investments to pay off over time. And let me tell you, this has been the key to much of my success. Now, I'm not suggesting you turn into a robot and completely shut off all emotions. That's impossible. But there's a difference between being aware of your emotions and letting them dictate your actions. In investing, awareness is power. It's about recognizing when your emotions are starting to cloud your judgment and then taking a step back to reassess. This is what separates amateurs from pros. For example, let's say you're watching the market drop and you start feeling that sense of panic creep in. The knee-jerk reaction is to start selling to cut your losses. But instead of acting immediately, take a deep breath and ask yourself, is this a short-term drop or is this a long-term problem? And does this panic reflect the fundamental value of the company I invested in? Most of the time, the answer is no, it's just a short-term market fluctuation. This is the beauty of emotional control. It helps you step back and make decisions based on facts, not feelings. Let me share a little story with you. Back in 2008, during the financial crisis, I made an investment in a company called Goldman Sachs. At the time, The market was in free fall, and everyone was panicking. People were calling me crazy, telling me to stay away from anything that had financial in its name. But I saw something others didn't: the long-term value. Goldman Sachs had an incredible track record, a strong management team, and a clear path forward. It was down temporarily, but I knew it would bounce back. Instead of letting fear drive my decisions, I stuck to my analysis, held my ground, and made a bold move when others were running for the hills. The result? That investment turned out to be incredibly profitable. But the key to making that call wasn't my ability to read the numbers. It was my ability to block out the noise and ignore the emotional reaction everyone else was having. So, let's break it down. How do you develop emotional control? Start by having a clear strategy. If you know exactly what your goals are, it's easier to stay on track when things get bumpy. If you're investing based on sound principles, whether that's long-term growth or building a steady stream of passive income, you won't be as tempted to panic every time the market takes a dip. Keep your eye on the long term. This is one of the most important lessons I've learned in my investing career. Focus on the big picture. Sure, the market might be volatile in the short term, but if you've made an investment in a fundamentally sound business, there's no reason to panic. Don't get caught up in the short-term noise. Look at your investments with a 5 to 10-year lens. If you're still confident in the company, hold steady. Understand that volatility is normal. Markets go up and down. That's just how it works. The key is to expect the volatility and prepare for it. You've got to understand that drops are just part of the cycle. The idea that you can avoid market drops altogether is a myth. The best you can do is ride out the waves and hold steady. Think about the best investors in the world. They've all faced periods of uncertainty. The difference is that they didn't let fear drive them to make hasty decisions. Get comfortable with being uncomfortable. This one might sound a little odd, but stick with me. If you want to be a successful investor, you've got to be comfortable with the discomfort that comes with market fluctuations. The truth is, you're not going to feel calm every day. There will be times when the market makes your stomach churn. But if you can learn to sit with that discomfort, it'll become much easier to make sound decisions. Avoid the herd mentality. I can't tell you how many people have come to me after the fact, saying, "I wish I'd stuck with my investments during the 2008 crisis instead of selling everything." The reason they sold, they saw everyone else panic. The problem with following the crowd is that you're more likely to make decisions based on fear, not reason. It's better to think for yourself. Stick to your strategy and make decisions based on logic, not emotion. In conclusion, developing emotional control isn't just about avoiding rash decisions during market dips. It's about creating a mindset that values steady, informed decision-making over fleeting emotions. If you can master this, you'll have a significant advantage over most investors, who are often ruled by fear or greed. Just remember, stay calm, stay focused, and keep your eyes on the long-term horizon. All right, let's shift our focus a bit and talk about something I truly believe is the foundation of every successful investment strategy: understanding what you buy. It's a principle that I've always followed, and it's been one of the keys to my success. You see, investing isn't just about picking stocks or bonds or putting money in the latest trending fund. It's about buying something that has real value, something you can understand and can reasonably predict will grow over time. The best way I can explain this is by referring to something I've said over the years. I'm not a stock picker. I'm a business buyer. And what I mean by that is simple. When I invest, I'm not just buying a stock. I'm buying into a business. I want to know everything about that company, their revenue model, how they make their money, how they treat their customers, their competitive advantage, and most importantly, whether their business will still be thriving decades from now. This is the core of value investing, and I can't stress it enough. You need to understand what you're buying. Let me paint a picture for you. Imagine you're walking into a car dealership. You're looking at different models and weighing your options. Some cars look fancy, sleek, fast, and with all sorts of shiny gadgets. But here's the question you need to ask yourself. Will that car last for the long run? It's one thing to buy a flashy car, but it's another to buy a reliable one. You could buy the one that looks the best on the outside, but if it's built on shaky foundations, doesn't have a reliable engine, and will probably need expensive repairs in the future, then you're not really making a wise investment. You're just buying a trend. That's how it is with stocks. You don't just buy the fancy ones that everyone else is talking about. You buy the ones that are built to last. Let me tell you a story about one of my most famous investments, Coca-Cola. When I bought shares in the company, the stock wasn't necessarily the flashiest, and it wasn't the most exciting. But what I did understand was that Coca-Cola had a product that people loved, and that people would continue to love for decades. It was a business with a massive competitive advantage. The moat, the thing that keeps competition away, was strong, and it wasn't going anywhere. Coca-Cola had a simple, effective business model that didn't need to rely on gimmicks or trends. The product was already a staple of people's daily lives. I could understand that. But here's the secret that many new investors miss. It wasn't just about the product. It was about the fundamentals. When you understand a business at its core, when you really get what drives its revenue, what keeps its customers loyal, and how it can weather economic storms, that's when you know you're onto something. And once you understand that, it's not about timing the market or betting on speculation. It's about investing in something that has real staying power. You can rely on that business model and sleep easy, knowing it's going to continue to perform over time. Now, let me give you a little historical nugget that illustrates this concept. Back in the 1950s, a company called Berkshire Hathaway was, at its core, a textile business. It wasn't anything special. It was struggling in many ways. But over time, I started to notice that there were better ways to use the capital of the company than just focusing on the textiles business. The question I asked myself was, where can I invest the money to create the most value? And so I started buying good, solid companies, things I understood, like insurance and consumer goods. It wasn't about chasing what was trendy or flashy. It was about finding things that were fundamentally sound, companies that had a lasting value, and businesses that I could hold on to for decades. You might think that a lot of what I'm saying here sounds like common sense, and honestly, it is. But the thing is, common sense isn't always common practice. A lot of investors get caught up in excitement. They buy stocks based on market movements, the buzz they hear around certain industries, or the next big idea that's gaining traction. But that's a dangerous game. When you buy something just because it's trending, you're more likely to get caught in the hype and end up with an investment that's not really built on solid ground. It's like buying a car for its looks, not its engine. Here's something else to keep in mind. Investing is a long-term game. The longer you hold a good business, the more the power of compounding takes over, and the better your returns will be. This is why understanding what you buy is so crucial. When you make the decision to invest in something, you want to be confident that it's a business you can hold on to for years, ideally for the rest of your life. And that doesn't just apply to stocks. This can apply to real estate, your savings, or any kind of asset you're considering. If you understand what you're buying, you'll have more confidence in the decision. Another concept here is to make sure you fully understand the risks involved. This is something a lot of people overlook. When you understand a business, you also have to understand its potential vulnerabilities. There's no such thing as a perfect investment, and every investment has its risks. The key is knowing what those risks are and being comfortable with them. That's why a good investor never just follows the crowd. They take the time to understand what they're getting into, weigh the risks, and then make an informed decision. Lastly, let me leave you with one more piece of advice. Trust yourself. It can be tempting to listen to others, to follow the crowd, or to jump into the latest hot investment. But at the end of the day, the best investment you can make is in something you understand and something you believe will continue to be valuable year after year. So, whether you're buying a business, a stock, or any other investment, ask yourself, do I really understand what I'm buying? If the answer is no, take a step back and learn more. Once you understand it, and once you believe in it, you're in the right place. Now, let's explore a concept that, while simple, can often be overlooked in the world of investing: the power of simplicity. In today's fast-paced world, we're often told that more is better, that to truly succeed, you need to do everything, have everything, and be everything. But here's the truth. Simplicity is one of the most powerful tools at your disposal when it comes to investing. And I've seen firsthand how sticking to a straightforward approach can bring long-term success. You might be thinking, but isn't investing complicated? Isn't there a need to stay on top of the latest trends, strategies, and tools? And yes, there are plenty of complex methods out there. But here's the thing. You don't need to overcomplicate things. One of my core beliefs is that the best investment strategies are often the simplest ones. When I look at my own investing philosophy, I see that it's built on a few key principles that anyone can grasp. Simplicity doesn't just make things easier, it makes them more effective. Think about it. When you keep your strategy simple, you can focus on what really matters. You don't get bogged down in unnecessary details or distractions. Instead of jumping from one trend to the next, you stick to your plan and stay committed to it. This kind of approach helps you stay grounded when the market is unpredictable and emotional, and it allows you to make decisions with clarity and purpose. One of the simplest pieces of advice I've always given is stick to what works. And what works? Investing in companies with strong fundamentals, competitive advantages, and reliable earnings growth. That's it. No need for complex technical analysis or constant monitoring of short-term market trends. It's about finding quality businesses that are built to last, and then holding on to them for the long haul. Let me give you an example. I've always been a big fan of investing in companies like Coca-Cola, American Express, and other consumer brands with long histories of success. These are businesses that people use every single day. No matter what's going on in the economy, it doesn't matter if the market is up or down. These businesses keep chugging along because they've built something simple, something that works. They don't rely on flashy gimmicks or constantly trying to reinvent the wheel. They've mastered their niche, and they stick to it. But simplicity doesn't mean doing nothing. In fact, simplicity requires discipline. It's easy to get caught up in the latest hype and try to jump on every new trend. But that's a mistake. Overcomplicating your portfolio with too many investments or strategies can actually reduce your chances of success. In fact, there's a term in the investing world that describes this perfectly: analysis paralysis. It's when you overanalyze everything to the point where you can't make a decision at all. The more complicated things get, the harder it becomes to move forward. Think about how often you've seen people get caught up in the complexity of investing, trying to track every single stock, attempting to time the market, or buying every new thing that pops up on their radar. Eventually, they either burn out or make bad decisions because they're overwhelmed by information. Simple investing, on the other hand, allows you to make clear, confident decisions without all the clutter. Here's a little historical tidbit for you. Did you know that many of the wealthiest investors in the world, including myself, got their start by following simple strategies? Warren Buffett wasn't looking for shortcuts or complex tricks. When he started, he was focused on understanding businesses and buying them at the right price. His strategy was simple. Look for companies with strong, understandable business models and buy them at a price that gives you a margin of safety. That's it. Simple, but incredibly effective. Now, simplicity doesn't mean there's no thought involved. It's about distilling your approach down to the essential elements. When I say simplicity, I don't mean ignoring the complexities of a business. Instead, it's about filtering out the noise and focusing on what really matters. In the world of investing, that means identifying businesses with clear, consistent earnings, strong leadership, and the potential for growth. Once you find those businesses, you stick with them. You don't let every market swing or news report dictate your decisions. The beauty of simplicity is that it works in both good times and bad. When the market is flying high, it's easy to get caught up in the excitement and start chasing after the next big thing. But when the market drops and fear sets in, it's easy to panic and make hasty decisions. However, if you have a simple, well-thought-out investment plan, you don't need to rely on market conditions to dictate your success. You stick to your strategy, even when things get rough. That's the power of simplicity. But here's the catch: simplicity takes time. It's not about jumping into the latest stock tip or listening to the next big pitch. It's about slowly building a portfolio based on timeless principles. So, if you're just getting started, don't be in a rush to make everything perfect. Build your strategy slowly and steadily, and always be willing to learn as you go. Simplicity, after all, is not about doing less. It's about doing the right things more effectively. Let me leave you with this. Don't overcomplicate things. Stick to the basics. Focus on what you understand, and keep your strategy simple. In the world of investing, less is more, and that's where true success lies. When you can remove the noise and focus on the essentials, you'll be amazed at how effective and fulfilling your investment journey can be. All right, Let's pause for a moment and talk about something that many people forget when they start their investment journey: controlling your expenses. You might think this is basic advice, but hear me out. So many people focus on maximizing their earnings, but they forget that managing expenses is just as important, if not more so. When you control your expenses, you control your future. It's simple, but it's one of the most powerful habits for achieving financial freedom. You don't need to be a financial wizard to understand this. If you spend less than you earn, you're setting yourself up for success. It's the foundational rule for building wealth. And yet, it's often the first thing that gets overlooked when people focus too much on the stock market or other complex strategies. Wealth isn't just about making money, it's about keeping it. And the best way to do that is by understanding where your money is going and making sure you're not wasting it on things that don't add value to your life. Now, I know what you might be thinking. Warren, you're a billionaire. You probably don't think about a budget. And yes, I do have significant wealth. But guess what? I still live below my means. I don't have to live frugally to be happy. But I've learned that it's important to keep my expenses in check. No matter how much money I make, it's about living within your means. And for most of us, it's about living well below our means. Let's take a historical example. When I first started, I didn't have all the money in the world. I didn't have a lavish lifestyle. I started out with modest investments, and the first thing I did was keep my living expenses low. In fact, when I bought my first home, I bought a modest house. Even today, I still live in the same home I bought decades ago. I didn't go out and buy a mansion or spend money on things I didn't need. Instead, I invested wisely, and I focused on growing my wealth, not spending it. But here's where most people go wrong. They think that wealth is about spending money on flashy things. They think that the key to a successful life is having the best car, the biggest house, or the fanciest clothes. But the truth is, those things don't bring happiness. They don't add to your net worth. They just take away from it. Think about the classic millionaire habits. If you look at the wealthy individuals who have achieved real financial freedom, many of them live surprisingly modest lifestyles. They drive average cars, live in reasonably priced homes, and rarely splurge on things that don't serve a purpose. It's not because they can't afford luxury, it's because they've made a conscious decision to prioritize their future, not their present indulgences. This is one of the greatest lessons I've learned in my life, and it's a lesson I want to pass on to you. It's simple. If you want to become financially successful, focus on cutting unnecessary expenses. Do you need that daily Starbucks? Do you need to upgrade your phone every year? Are those $200 shoes really worth the price tag? We all have these little habits that chip away at our savings. And it's important to be mindful of where your money is going. If you're serious about building wealth, you need to look at your spending habits with a critical eye. But here's a trick that many people miss. It's not just about cutting back on the things you enjoy. It's about eliminating the things you don't even realize you're wasting money on. Maybe it's that gym membership you never use, or those subscriptions you forgot you even signed up for. Maybe it's simply eating out too much or buying things on impulse. Those things might seem insignificant in the moment, but when you look at the bigger picture, they add up. The key is being intentional with your spending. It's about making sure that the money you do spend is going toward things that add value to your life. That doesn't mean you can't enjoy life or treat yourself every now and then. But it's about being smart with your choices. Instead of blowing money on short-term gratification, focus on investing in things that will improve your future, whether that's investing in stocks, building an emergency fund, or even spending on education that will improve your skills. I know this isn't the fun part of investing, but it's crucial. Wealth is built slowly, and it's built on the foundation of smart, disciplined spending. The more you keep your expenses in check, the more you can invest in your future. If you keep your spending low, you'll have more to invest, and over time, that's what will make the difference between a comfortable retirement and struggling to make ends meet. But there's something even more powerful than just controlling your expenses. It's the concept of saving consistently. The most important thing you can do is set up a system where you save a portion of every paycheck, every month, without fail. And when you save, don't let it sit in a regular savings account earning nothing. Invest that money wisely. This is where compounding comes into play again, and it's why saving regularly is one of the best habits you can develop. Now, you might be wondering, what if I don't have enough to save right now? My answer is simple. Start small, even if it's just 10 a week. Start with what you can. Over time, as your wealth grows, you can increase your savings. The key is to get into the habit of saving, no matter how small the amount is. Consistency is the key. When you get used to saving, it becomes second nature, and that's when you start seeing the true power of compounding. In the end, controlling your expenses isn't about denying yourself everything you want. It's about being strategic. It's about recognizing that the more you save and invest, the more freedom you have in the future. So, focus on keeping your expenses low and use the difference to build your wealth for the long term. It's simple, but it works, all right? We've covered a lot of ground already: patience, simplicity, emotional control, and even the importance of controlling your expenses. But now, let's take a moment to talk about something equally crucial in the world of investing: integrity. I know, you might be thinking, Warren, what does integrity have to do with making money? And to that, I say, everything. Integrity is what builds trust, and trust is the foundation of every successful business relationship. Whether you're working with partners, customers, or investors. You see, in the world of investing, people often focus too much on numbers and strategies, and they forget about the one thing that truly holds everything together: honesty. Without integrity, everything else is just a house of cards. I've often said that when it comes to investments, your reputation is everything. When you deal with companies, other investors, or even your own clients, they have to trust you. They have to believe that your word means something. In my early years, I realized that my reputation was the most valuable asset I had, and I made sure to protect it by being transparent, by making decisions that aligned with my values, and by doing what I said I was going to do. Let me tell you a story. Back in the 1960s, I was looking to buy a company. It wasn't a huge company, but it had great potential, and I could see the future growth. But here's the thing. The company had a little-known debt issue, something that wasn't on the surface, but could have been a serious problem down the road. So, I had a choice. I could have ignored it and gone ahead with the purchase, keeping my fingers crossed that no one would notice. After all, the deal was still good on paper, but instead, I did the right thing. I disclosed the issue up front and explained it to the sellers. This wasn't an easy conversation to have, but it was the right one. And in the long run, it was that honesty that built the trust that allowed for a smoother deal and a better relationship in the future. Integrity is about more than just honesty. In business deals, it's also about doing the right thing when no one's watching. It's about building a legacy based on doing what's right, not what's convenient. And that's one of the most powerful principles in investing. People will always remember how you treated them, how you followed through on your word, and how you made them feel secure in their investments. Let's take a step back and look at a historical example. One of the most well-known companies that built its success on integrity is Johnson & Johnson. During the 1982 Tylenol crisis, when some bottles were tampered with and laced with cyanide, the company didn't hesitate to pull all of its Tylenol products off the shelves despite the financial consequences. They put the safety and trust of their customers above short-term profits. That's integrity in action. They could have ignored the problem or swept it under the rug. Instead, they chose to do the right thing. In the long run, that decision cemented their reputation and solidified their position as one of the most trusted brands in the world. Integrity is also about being transparent with your investors, your partners, and your clients. If things are going wrong or a mistake has been made, don't try to cover it up. Admit it, fix it, and learn from it. People respect honesty, even when the news isn't good. Integrity isn't about always being perfect. It's about owning up to your mistakes and doing everything in your power to make things right. Now, some might argue that integrity isn't always the best business strategy. They might tell you that, in certain situations, bending the rules or cutting corners is the best way to get ahead. But let me tell you this, that might work in the short term, but it will come back to bite you in the long run. History is full of examples of companies and individuals who cut corners, used deceit, or took shortcuts to make quick profits. Sure, they might have seen a big spike in the short term, but eventually, the truth comes out, and when it does, the fallout can be catastrophic. Historians still argue whether some of the world's most famous corporate scandals could have been avoided with just a little more transparency and integrity. Think about Enron. For example, their rise and eventual fall were marked by a culture of deceit and dishonesty. They had impressive numbers, huge projections, and everything looked perfect on paper. But when the truth came out, it wasn't just the company that collapsed, it was the entire trust structure that had been built around it. When you invest with integrity, it's not just about following the law, it's about building a reputation that will last long after the deal is done. Trust is what enables relationships to grow over time. Whether you're working with clients, employees, or partners, trust is the foundation of every successful venture. Without it, nothing lasts. But here's the good news. Building integrity into your investment philosophy isn't hard. It starts with small actions telling the truth, being transparent, and always following through on your promises. The more you make these actions a habit, the more they will define your reputation, and in the end, your reputation is what will keep you ahead of the competition, even when the market is unpredictable. So, in every investment decision you make, ask yourself, what's the most honest decision I can make here? And always remember, the truth may not always be the easiest path, but it's the one that will lead you to long-term success. Now that we've established the importance of integrity, let's dive into something that might sound a little counterintuitive to many: learning from your mistakes. I know, it's easy to want to avoid mistakes. Nobody likes to fail. But here's the truth. Failure is not the end. It's simply a step along the way to greater success. If you learn from your mistakes, you can turn them into your most powerful teachers. Let me tell you why embracing failure is one of the best things you can do as an investor. You see, when I started out, I made plenty of mistakes. Nobody's perfect. But what I did differently was to learn from those mistakes and adapt my strategy. Every mistake was a lesson, and every lesson made me a better investor. What I learned is that mistakes are not something to fear. They're an opportunity to learn and grow. The key is to make sure that each mistake brings you closer to wisdom, not further from it. Let's talk about something that a lot of people don't realize. Most successful people fail more than they succeed. Think about it. Every great business person has had failures along the way. Steve Jobs, for example, was fired from the company he founded, Apple, before coming back years later to transform it into the powerhouse it is today. Do you think he let his failures define him? No, he learned from them, grew, and came back even stronger. And that's the key. Failure is just a stepping stone. But let's get a little more personal here. You may not know this, but one of the biggest mistakes I ever made was with a company called Dexter Shoes. I bought it in the early 1990s. I thought it was a great business one with lots of potential. But here's the thing. I didn't understand the competitive landscape enough. The company was competing with cheap imports, and it didn't have a strong enough position in the market. That investment turned out to be a massive failure. And here's the punchline. I lost $3 billion on that investment. Yes, you heard me right. $3 billion. It was a tough pill to swallow, but it was also one of the most valuable lessons I've ever learned. I didn't make the same mistake again, and I made sure to never forget the lesson that came from it. Do your homework, understand the competition, and always be realistic about the challenges a company faces. The key, though, is not just to recognize that you've made a mistake. The key is to analyze it. When you make an investment mistake, take a step back, look at what went wrong, and ask yourself, why did this happen? What can I learn from it? How can I avoid making the same mistake in the future? It's not about beating yourself up. It's about adjusting your strategy based on the lessons you've learned. This doesn't just apply to investing. Either think about all the times you've made a decision in your life that didn't work out as planned. Maybe you bought something that turned out to be a waste of money, or you took a risk that didn't pay off. In those moments, you can either let your mistakes define you, or you can use them as an opportunity to grow. The choice is yours. Now, here's something that might surprise you. I've also made mistakes by staying in investments too long. For example, there were times when I stuck with companies that didn't perform as well as I had hoped, simply because I didn't want to admit I was wrong. In hindsight, those were mistakes. Being willing to admit when you're wrong is just as important as learning from your successes. But here's the trick. Don't let mistakes scare you into inaction. A lot of people avoid making decisions because they're afraid of failing. But here's the thing. Doing nothing is also a decision. If you're not willing to take risks and learn from your mistakes, you're never going to make any progress. The key is to take calculated risks, learn from the failures along the way, and keep moving forward. Let me give you a little story about one of my earlier investments, Geico. In the 1970s, I bought a large stake in this auto insurance company. At the time, it wasn't exactly a household name. In fact, many people thought I was crazy. The company had been struggling for years, and a lot of analysts didn't see its potential. But I understood the business, I understood the numbers, and I saw something that others didn't. Geico had a huge competitive advantage in its low-cost model. Fast forward to today, and Geico is one of the most profitable companies I own. But that success didn't come overnight. It came after years of learning from mistakes, adjusting strategies, and continually improving the business. If I had let my early mistakes discourage me, I wouldn't have been able to capitalize on the incredible opportunity Geico turned out to be. But here's the kicker. Failure is never fatal. I know it feels like it when you're in the middle of a tough situation. But every failure is temporary. It's a bump in the road, not the end of the journey. The real key is persistence. Keep pushing forward, learn from your mistakes, and don't be afraid to make new ones. Because, ultimately, those mistakes are what will make you better. The more mistakes you make, the more lessons you'll learn, and the closer you'll get to success. Remember, success doesn't come from never failing, it comes from failing, learning, and improving. If you're afraid to fail, you'll never get to where you want to go. But if you embrace failure as a teacher, you'll be unstoppable. So, the next time you make a mistake, or if you're facing a failure, don't get discouraged. Learn from it, adjust, and keep moving forward. That's how you turn mistakes into opportunities, and that's how you become a better investor and a better person. Now that we've explored learning from mistakes, let's discuss something else that's essential to your financial journey: investing in what you understand. I can't stress this enough. A lot of investors get caught up in trends, hot tips, or the latest investment fad. But the truth is, the best investments are often the ones you can explain easily to a friend. If you can't explain how a company makes money and why it will succeed in the long run, then maybe it's not the right investment for you. I've always said, never invest in a business you cannot understand. And I really mean that when you invest in something you understand, something that's simple and straightforward, you'll feel confident when times get tough. You'll be able to see past the noise, stay calm during market dips, and focus on the long-term picture. But when you invest in things you don't understand, it's like flying blind. The unknowns will overwhelm you, and fear will dictate your actions. One of the biggest reasons I've been able to achieve success in investing is that I've stayed within my circle of competence, the things I know and understand. For example, I've always been comfortable with companies that are easy to understand: consumer goods, insurance, and even things like newspapers and railroads. I understand how these businesses work, how they make money, and what drives their success. When I invest in these types of companies, I know exactly what I'm getting into, and I can make decisions with confidence. Let me give you a historical example to make my point clearer. One of my early investments was in a company called Geico. At the time, it wasn't a household name, and a lot of people thought I was crazy for investing in an auto insurance company. But I understood how insurance worked. I understood the economics of the business, how it made money by collecting premiums and investing them wisely. Geico had a unique business model that offered cheaper insurance rates by selling directly to consumers. This meant they had a lower cost structure than their competitors. I could see the potential, so I went for it. And here's what happened. Geico became a massive success. Over time, its customer base grew, and the company's stock price skyrocketed. But none of that would have happened if I didn't truly understand how the business worked. It wasn't about following the crowd or jumping into a trendy industry. It was about recognizing something that made sense to me and then sticking with it. Now, don't get me wrong, I'm not saying you should only stick to what you already know. That's not the point. The point is that you should invest in what you understand well. If you don't know much about technology, for example, that doesn't mean you can't invest in tech companies. But it does mean that you should take the time to educate yourself about the sector before diving in. Learn how the companies make money, what their competitive advantages are, and what risks they face. This knowledge will empower you to make better decisions. I've also seen people make the mistake of following the herd, investing in things just because they're popular or seem like a hot opportunity. You know the type. people rushing into the latest tech IPO or buying up cryptocurrency without understanding how it works. They're driven by FOMO, fear of missing out. And while some people get lucky with these types of investments, many others don't. They end up losing money because they didn't understand what they were investing in. So, how can you avoid this pitfall? It's simple. Invest in businesses or assets that you can understand at a fundamental level. For example, if you're someone who doesn't know much about the tech world, don't jump into a tech stock just because it's trending. Instead, consider investing in a business that makes products or provides services you use every day. Maybe you understand the food industry or consumer products. Those are areas you can feel confident in. There's no shame in staying in your lane. In fact, it's one of the best strategies for long-term success. Another important aspect to consider is understanding the risks of the investments you make. For example, in the world of stocks, some businesses have more risk than others. New startups may have higher growth potential, but they also have a higher chance of failing. On the other hand, established companies like Coca-Cola or Procter & Gamble have been around for decades, with stable business models and reliable growth. When you understand the risks associated with your investments, you can make better decisions and avoid unnecessary losses. Here's a quirky tidbit for you. Did you know that Walt Disney once invested in a small company that was producing a product he didn't understand at all? It was an early foray into the computer industry, and he didn't know the first thing about it. But he was intrigued by the technology and the potential. And while Disney was always a visionary, this was one of those moments where he should have stuck to his core strengths. He ended up losing a substantial amount of money because he didn't truly understand the business. It wasn't until much later that Disney embraced technology more strategically, starting with the animation studios. This brings me to an important point. You don't have to be an expert in every industry, but you do need to be honest with yourself about your level of knowledge. If you don't understand a business, don't invest in it. Instead, put in the effort to understand what makes that business tick. The more you learn, the better your chances of making a smart investment. Let me end with this. Trust your instincts. If something feels like a gamble and you don't understand why it works, it probably is. Stick to what you understand, and the rest will follow. Over time, you'll gain confidence, and that confidence will make your investment strategy even stronger. Now that we've covered the importance of understanding what you invest in, let's shift gears and talk about something that might seem a little abstract, but is just as crucial to long-term financial success: the power of consistency. You may not think of consistency as a game changer, but trust me, it is. It's the quiet force behind so many of the world's greatest success stories. The consistent, disciplined actions that add up over time are what lead to wealth, security, and freedom. But here's the catch. Consistency isn't glamorous. In a world that loves instant gratification and flashy results, consistency is a bit of an underdog. You don't hear people cheering for the person who shows up every day, putting in the same effort, making small improvements over time. No one's going to throw a parade for the person who sticks to their savings plan month after month, or the investor who keeps adding to their portfolio every year, no matter how small. But guess what? That's the person who ends up winning in the long run. Here's why. Building wealth doesn't require a bunch of grand, dramatic moves. You don't have to time the market perfectly or make that one game-changing investment. What you need is the ability to keep going, day after day, making those small, consistent decisions. This is something that can't be emphasized enough. I'll tell you a story from my own life. When I first started investing, I wasn't making huge moves. In fact, my investments were relatively small, especially when you compare them to the billions I deal with today. But what I did have was discipline, the consistency to keep investing a little bit over time. It wasn't about making quick, massive gains. It was about building a solid foundation, one step at a time. I was committed to putting in the work consistently, no matter how slow the progress seemed. And over time, it paid off. The thing about consistency is that it compounds. The more consistent you are with your investments, the more you give your money the opportunity to grow. It's the same idea we discussed earlier with compounding interest. The more time you give your investments, the greater the impact. But if you stop and start, if you're inconsistent in your approach, that growth won't happen as effectively. This principle doesn't just apply to investing, it applies to every part of your financial life. Consistency in saving is just as important as consistency in investing. If you save a small amount every month, you'll be amazed at how much you can accumulate over time. The key is not to focus on how much you're saving now, but on the fact that you're doing it consistently. When you save regularly, no matter how small the amount, you're setting yourself up for long-term success. Now, let me throw a little historical perspective in here. Thomas Edison, one of the greatest inventors in history, wasn't an overnight success. In fact, he failed hundreds of times before he succeeded. But what made Edison a legend wasn't his one big breakthrough. It was his relentless consistency. He didn't give up when things got hard. He kept going, kept experimenting, and kept improving. That's what made him great, and it's exactly what makes you great as an investor. It's the ability to show up, keep working, and trust that's small. Consistent actions will add up over time. But let's talk about something a little more concrete. Regular investing. One of the most powerful tools at your disposal is something called dollar cost averaging. This strategy is all about consistency. Instead of trying to time the market, which we all know is almost impossible, you invest a fixed amount at regular intervals, no matter what the market is doing. Whether the stock market is up or down, you keep investing. Over time, you'll end up with a lower average cost per share, and you won't have to worry about trying to time the market perfectly. This approach takes emotion out of the equation, which, as we've discussed, is one of the most powerful ways to ensure success. One of the reasons this strategy works is because of market fluctuations. You don't need to guess when prices are low and buy in at the perfect time. Instead, you invest regularly, and over time, you benefit from buying more shares when prices are lower and fewer shares when prices are higher. This smooths out the volatility and minimizes the risk of trying to jump in and out at the wrong time. But let me clarify. Dollar cost averaging isn't about getting rich quick. It's about creating steady growth over the long term. It's about making consistent contributions, even when you're unsure of where the market is headed. And over time, that steady commitment will create incredible wealth. You might be thinking, but Warren, how do I stay consistent when things are tough? And that's a valid question. The truth is, there will be times when you feel discouraged. There will be moments when the market dips, and it feels like all your efforts are for nothing. But this is where consistency really shines. When the market is down and others are panicking, you have to stick to your plan. You have to remind yourself that you're in this for the long haul, and that consistency is the key to ultimate success. I know it's easy to get sidetracked by the noise, especially with the daily fluctuations and constant media coverage. But the most successful investors are the ones who ignore the noise. They keep their eyes on the prize. Stay consistent, and don't let short-term dips derail their long-term plans. Remember, you don't need to make huge leaps every day. The most successful wealth builders are the ones who take small, deliberate steps and keep moving forward, no matter what. Consistency is what turns small actions into massive results over time. So, whether you're just getting started or whether you've been at it for years, remember this: small, consistent actions are the ones that add up to success. Keep investing, keep saving, keep learning, and stay disciplined. Over time, you'll be amazed at how far that consistency takes you. All right, now let's move on to something that often gets lost in the noise of everyday investing and wealth-building advice: the importance of having a strong team. You might think that successful investors do it all on their own. But let me tell you, nobody succeeds alone. No matter how smart or talented you are, you'll need a team of trusted people around you to help make the best decisions and ensure your financial journey is headed in the right direction. When I first started out, I didn't have everything figured out. I needed advice, support, and guidance from people who knew more than I did. And over the years, I've come to realize that having a strong team behind you is one of the most valuable things you can have. Whether it's your partners, advisors, or the people you work with day to day, your team plays a critical role in your success. I've always said, it's better to have a great team and a so-so idea than a so-so team and a great idea. The people you surround yourself with are just as important as the investments you make. A great team helps you make better decisions, gives you a fresh perspective when you're stuck, and fills in the gaps where your own knowledge may be lacking. It's the power of collaboration. Let me give you a personal example from my own journey. Berkshire Hathaway, the company I lead, wouldn't be what it is today without my business partner, Charlie Munger. Charlie and I have been working together for decades, and he's been an invaluable resource in shaping the way I approach investing. His ability to analyze situations from a different angle has saved me from countless mistakes and helped me make smarter, more well-rounded decisions. But the truth is, Charlie and I wouldn't have gotten as far as we have without a team of talented individuals who support us and provide insight into areas we might not be experts in. Here's the thing. When you're building a financial empire or even just a solid personal portfolio, you don't need to have all the expertise yourself. You don't need to know everything about every market or sector, but you do need to bring in people who can complement your skills and make up for what you don't know. This is why I've always made it a point to hire or partner with individuals who are experts in areas where I'm not. This concept goes beyond investing. It applies to any major decision in your life. Whether you're starting a business, buying a house, or planning for your retirement, the right team can make all the difference. You need people who can give you good, sound advice and who have your best interests at heart. When you surround yourself with the right people, they'll help you avoid costly mistakes and guide you toward making better, more informed decisions. But what makes a good team? The first quality I look for is trustworthiness. Without trust, everything falls apart. The second is expertise. You want people who are not just good at what they do, but who are passionate about it. The third is communication. You need people who can communicate openly and honestly, even when the truth might be hard to hear. And lastly, you need people who challenge you, not just agree with everything you say. A great team pushes you to think outside the box and brings new ideas to the table. Let me tell you a funny, quirky tidbit. Did you know that even though I've had an incredibly successful career in finance, I still don't know how to run a computer? I mean, I know the basics, but when it comes to technical details, especially the complex stuff, I'm completely lost. That's why I have people on my team who specialize in technology and understand things I don't. It's not a weakness. It's part of being a smart leader. I know where I excel, and I know where I need help. And I'm not afraid to lean on my team for support when I need it. Now, here's where it gets really interesting. Building a great team isn't just about hiring experts or finding people who are skilled in specific areas. It's also about finding people who share your values. When everyone on your team is aligned with your principles and goals, things run smoothly. If your team isn't on the same page or if there's a disconnect in values, things can get pretty messy. Think about it this way. When you're working with a team that shares your values, your communication is more fluid. Your decisions are easier to make, and you all work toward the same outcome. Whether you're making investment decisions or building a business, shared values create a sense of unity, and that unity is what will help propel you forward, even when things get difficult. Now, let's be clear. A great team doesn't mean that you'll never make mistakes. You'll still hit bumps along the way, but a great team will make those mistakes easier to manage, because you'll have the right people around you to help navigate the challenges and come up with solutions. The key is to build a team you can trust, and to always ensure that everyone is aligned toward the same goal. When I think about Berkshire Hathaway and the many great people I've worked with over the years, I realize that our success isn't just about me and Charlie, it's about the whole team. It's about the people who have made wise decisions, who have brought new perspectives, and who have helped us stay grounded in our values. That's what's made all the difference. So, what does this mean for you? It means that you need to surround yourself with the right people. Whether it's a financial advisor, a business partner, or a trusted mentor, having a great team can make all the difference in your success. And if you don't have a team yet, start building one. Look for people who can help you grow, challenge your thinking, and bring expertise to the table. Trust me, you'll be glad you did. All right, we're nearing the end of this journey. And I want to leave you with something that's not just about investing, but about life itself, living with purpose beyond money. It's easy to get caught up in the chase for wealth, and it's tempting to think that the more money you have, the happier you'll be. But I've learned through years of experience that while money is important, it's not everything. There's something much more important that guides me. Purpose. Let me tell you something I've come to realize over the years. Money is a tool, not a destination. It's a means to an end, but the end is not simply to have more money. The real goal is to use money to live a life with meaning, to make a positive impact, and to create value for others. If you're just chasing money for the sake of money, you'll eventually find that it doesn't bring true fulfillment. But if you focus on creating value, on doing meaningful work, and on living with a sense of purpose, money will follow. This is one of the key principles I've always followed. Yes, I've made money, and a lot of it, but I've never viewed wealth as the end goal. The real goal for me has always been to make a difference, to help others, to invest in businesses that create jobs and opportunities, and to contribute to causes that matter. Money is a byproduct of doing good work, making smart decisions, and living with integrity. Now, you might be wondering, how does this apply to you? You might not be a billionaire, and you might not have a vast empire of companies under your name, but you do have something incredibly valuable, the ability to shape your own life, and that's the real wealth. It's about having the freedom to do what you love, to pursue your passions, and to make decisions based on your values. A lot of people think that once they reach a certain financial milestone, whether it's a certain amount in the bank, a big promotion at work, or paying off debt, then they'll finally be happy. But let me tell you, happiness doesn't come from numbers. It doesn't come from accumulating more and more stuff. It comes from doing what fulfills you, whether that's helping others, creating something meaningful, or simply living life on your terms. And let me tell you something else. Success in life isn't about what you have. It's about what you give. The more you focus on serving others, on making a positive impact in your community or in your work, the more you'll find fulfillment. This is something I've learned from my own experiences and from observing the lives of other successful people. When you focus on creating value, wealth and success come as a natural consequence. But here's the trick. Find your purpose before the money comes. If you start with a mission, a sense of purpose, you'll find that the financial success follows. I've seen this time and time again. People who start businesses, start careers, or even start investing with a sense of purpose, whether it's helping others, solving a problem, or making life better for someone, end up being far more successful in the long run. They don't just focus on making money, they focus on making a difference. Let me share a story with you. A few years ago, I was talking to a young entrepreneur who was looking for advice. He had all the technical knowledge, the passion, and the drive to succeed. But there was one thing he was missing, a sense of purpose. He was chasing profits, and that's all he could see. I told him that if he wanted to succeed, he had to focus on why he was doing what he was doing. What problem was he solving? How was he going to make a difference in the world? Once he found that sense of purpose, everything changed. His business took off, and the profits came naturally. This is the power of living with purpose. It aligns your actions with your values, and that's when you find true fulfillment. You don't have to be a billionaire to make an impact. You can start small, with the work you do, the people you interact with, and the decisions you make every day. It's about adding value, living with integrity, and contributing to something larger than yourself. And here's something to think about. If you can create value in the world, the financial success will come naturally. When you help others, when you solve problems, when you add something meaningful to the world, whether it's through your job, your investments, or your actions, wealth will follow. It won't be immediate, but it will come in its own time. So, as you move forward in your journey, whether you're just getting started or you've been at it for a while, remember this: don't focus solely on the money. Focus on your purpose. Focus on the value you can create. The money will come as a result of the positive impact you have on the world. And when you live with purpose, not only will your financial future be secure, but your life will be richer in ways that go far beyond wealth. Before we wrap up, I want to leave you with this thought. Success is not a destination, it's a journey.